All right, today we're going to deconstruct a professional analyst report on a company called Kraken Robotics. We're going to peek behind the curtain, see what the pros are thinking, what's got them concerned, and maybe where they see a little bit of magic. So, what's the final word? Let's dive in.
Wow. Okay, so right out of the gate, they are not messing around. The report just drops this incredibly blunt, negative conclusion on you. I mean, this isn't some wishy-washy, on the one hand kind of analysis. For anyone thinking about investing, this is a huge, flashing red light from the very first sentence.
And that really sets up the central question for us, doesn't it? It's like a whodunit, but for investing. Why are they so skeptical? What did they see that led them to this verdict? We're going to play detective here and unpack all the evidence piece by piece. All right, first things first, let's look at the official verdict. This is the big takeaway, the one number that boils down their whole analysis.
And there it is, a 2-star rating. Now, on Morningstar's scale, that goes up to 5 stars. So a 2? Yeah, that's a pretty clear signal. They're basically saying, hey, we think this stock is way too expensive right now, and you should probably stay away.
Okay, so before we dig into the why behind that 2-star rating, we need to get our bearings. Who exactly is Kraken Robotics? What's their business?
So, in a nutshell, Kraken is a super high-tech company that deals with marine technology. Think deep-sea stuff. They make and sell really sophisticated underwater equipment. We're talking advanced sonar, underwater robots, that kind of thing. Their main customers? The military and big commercial operations. And just to be clear, they make their money selling the actual hardware, the products, not so much from services.
All right, now we're getting to the heart of it. The real core of the analyst's argument, the #1 reason for that low rating. And it all boils down to a single, critical word: valuation.
So to really get this, we have to understand 2 ideas. First, there's the market price. That's easy, right? It's just the price tag on the stock exchange today. But then there's fair value. That's what the analyst, after all their number crunching, thinks the company is actually worth. And believe me, the difference between those 2 numbers, well, that's where the whole story is.
And this chart right here, it just lays the problem out perfectly. That black line, that's the stock's actual price, what people are paying. And the red line below it, that's what Morningstar thinks it should be worth. You don't need to be a Wall Street genius to see the problem. The stock is living way up high in what they call the overvalued zone.
And we can put a number on it. The report says the stock is trading at a 17% premium. 17%. That's a pretty big gap between perception and reality, at least according to this analysis.
So what does that high price tag really mean? What is it telling us? It's saying that the market, all the investors out there, are extremely optimistic about Kraken. They're basically making a huge bet that this company is going to grow like crazy and that future growth makes it worth paying a premium for today.
And it's not just that one metric. The report highlights other warning signs. There's this thing called the enterprise value to EBITDA ratio. I know, it's a mouthful, but it's basically a price-to-earnings comparison for pros. And Kraken's number is a jaw-dropping 165.8. That puts it in the top 10%, the most expensive companies compared to its peers around the world. On top of that, it pays 0 dividends. So the picture you get is of a really, really pricey speculative stock.
But, and this is a big but, here's where the story takes a turn. It's not all doom and gloom, because the same report that's waving all these red flags also has some really good things to say about the actual business, specifically about its competitive advantage.
So you have to ask, right? If the stock is so expensive, is there anything good happening with the company itself? Anything that could possibly justify that price? And surprisingly, the analysts say, yeah, there is.
And that something brings us to this really cool concept called an economic moat. The image of a castle is perfect. A moat protects a castle from attackers, right? While an economic moat protects a company from its competition.
And here's the kicker. Morningstar has given Kraken a narrow moat rating. Now that is a huge deal. It's their stamp of approval. It means they think this company has a real lasting advantage that will let it beat the competition and make solid profits for at least 10 years. That's a powerful statement.
Okay, now check this out, because this is where it gets really interesting. Look at this history. For years and years, Kraken was rated as having no moat. 0, zilch. This new narrow moat rating, it's brand new. They just earned it. And what that tells you is that something fundamental, something really positive, has recently changed for the better inside this business.
So, a new moat sounds fantastic, but talk is cheap, right? Is this new strength actually showing up in the financial results? Let's follow the money and see what the numbers have to say.
And wow,
Here is the story right in the data. Just look at the revenue on the left. It's not just growing, it's exploding, from about $12 million in 2020 to a projected $91 million in 2024. That's incredible. But even more important, look at the net income on the right. For years, they were losing money, and then, boom, in 2023, they finally turned a profit. And it's not just a small profit, it's projected to get much, much bigger.
So there you have it. The numbers are telling the exact same story as the moat rating. 2023 was the turning point. It was the moment all that potential, that competitive advantage, finally started turning into cold, hard cash.
Okay, let's step back and put all the pieces together. What we have here is this really fascinating conflict, this tug of war between an expensive stock price on one side and a rapidly improving business on the other.
And this really breaks it down perfectly. You've got the bear case, the pessimistic view. That's why they got the 2-star rating. It's all about that high price and the scary valuation numbers. But then you have the bull case, the optimistic view. And that's all about the amazing story of the business itself, that new moat, the insane revenue growth, and the fact that they're finally making money. It's the classic investing dilemma, a great company versus a pricey stock.
Which brings us to the final million-dollar question that every single investor has to wrestle with. Does a fantastic, promising company justify paying a really high price for its stock today? The analyst's answer is pretty clear. For them, the price is just too steep, at least for now. But at the same time, they're telling you that the business itself is getting better and stronger every day. And that tension right there, that's what makes this whole game so difficult and so fascinating.